In today's video, we have some mind-blowing news that will shake the foundation of the US housing market. You won't believe what's happening with Wall Street landlords. They've suddenly stopped buying homes, and there are rumors of a fire sale in the near future. We have some eye-opening data that reveals the impact this will have on home prices, and trust me, you'll want to stick around to find out more. So, make sure to subscribe to our channel, hit the notification bell, and let's dive into this game-changing housing market update. In a surprise turn of events, major Wall Street investors such as Blackrock, Blackstone, Opendoor, and Invitation Homes are withdrawing from the U.S. housing market. According to a report by Fortune, these prominent buyers purchased 90% fewer homes at the beginning of 2023 compared to the previous year. This development may seem as a positive development for regular home buyers and small investors, as it signifies a reduction in competition from these influential Wall Street players, particularly in current housing markets across the southern region. Notably, data from Redfin indicates that in 2022, cities like Jacksonville, Atlanta, and Phoenix experienced a significant investor presence, with investors acquiring 65% of the houses, particularly in specific zip codes like Wynwood in Miami. Consequently, the anticipated outcome is a considerable decline in home prices within these markets and zip codes. The reluctance of Wall Street buyers to engage in the housing market can be attributed to a combination of three factors. Firstly, escalating evictions have led to increased vacancy rates in apartments and homes. Secondly, rental growth has significantly declined, reaching negative values in numerous cities. However, the most crucial factor is the surge in mortgage interest rates, which renders it unfeasible for these investors to generate profits. At present, the 6.4% mortgage rate is higher than the 4.6% cap rate, further discouraging investment. Among Wall Street buyers, Invitation Homes, the largest owner of single-family homes in America, has drastically reduced its purchasing activity. As outlined in the Fortune article, their acquisitions have reached their lowest level in years, while their sales have increased. Notably, Invitation Homes currently owns over 85,000 homes. However, some may need clarification on why these changes in investor behavior have not resulted in faster declines in home prices across various cities. With rising home prices in March and persistently lower inventory levels, the main hurdle lies with steadfast sellers, primarily regular homeowners, to list their properties, and when they decide to sell, they often ask for prices well above market value. For instance, a listing located south of Nashville in Brentwood, Tennessee, is currently listed at $850,000, despite the Zillow home value estimate of $693,000, showcasing a significant 20% markup by the seller. Surprisingly, this issue has received limited attention from mainstream real estate media, despite its significance. Retail prices are now declining in many cities, with data from Apartment Listing indicating that 40 out of the 100 largest cities in the U.S. have experienced negative year-over-year rent growth as of April 2023. Markets like Jacksonville, Memphis, Austin, Phoenix, Las Vegas, and Seattle are among those officially experiencing declining rents, with the most significant decreases observed in Nevada, Northern California, and Arizona, where rent has dropped from around 5% compared to the previous year. Notably, a 5% decline does not indicate affordable rents, as they had previously risen by a much larger margin. However, any decline in rental prices poses significant challenges for investors. It signals deflationary forces within the economy that will likely lead to lower home prices in the long run, as rental rates ultimately influence home prices. One of the key factors contributing to the decline in rents is the surge in evictions across the country. Shockingly, data from the Eviction Lab reveals that there have been 2.2 million evictions since the start of the pandemic, with eviction rates significantly accelerating in markets such as Austin, Columbus, Fort Worth, Jacksonville, Las Vegas, Miami, Minneapolis, Nashville, Phoenix, Pittsburgh, and Tampa. This eviction surge was not entirely unexpected, as many experts predicted its occurrence over the past year. The stark reality is that rents increased significantly during the pandemic, surpassing the growth of people's incomes. As a result, renters find it increasingly challenging to afford the inflated rental prices. When the moratoriums on eviction and government renter assistance expired, tenants were left grappling with paying rent that had increased by 20, 30, or even 40%, while their wages had only risen by 5 to 10%. This mismatch inevitably led to a surge in evictions. In cities like Las Vegas, eviction rates have been hit hard, with rates currently running approximately 60% higher than pre-pandemic levels. The consequences of these evictions are exacerbating the problem of vacant apartments, with the rental vacancy rate in Las Vegas skyrocketing from 2.5% in August 2021 to a record high of 8.4% in April 2023, according to data from Apartment List. Another city experiencing a surge in vacant units is Phoenix, where the vacancy rate has reached 7.4%. It is anticipated that Los Angeles will soon follow suit, as the city recently repealed its 3-year-long eviction moratorium, leading to an anticipated backlog of evictions in LA County. With these circumstances, it is understandable why Wall Street buyers are opting out of the housing market. It is unlikely that they will return until both home prices and interest rates experience a significant decrease. The director of single-family residential at Yield Street, a prominent Wall Street buyer, shares this sentiment, emphasizing the need for substantial price reductions and interest rates to entice investors back into the market. The current state of home buying strategies is in pause across the board, waiting for short-term interest rates to reach around 4% and for home prices to decrease by about 15% from their peak. The unemployment rate in the labor market is a key factor affecting when this will happen. Although the reported unemployment rates in America is currently as low as 3.4%, history shows that during recessions, such as those experienced in California, the unemployment rate surges close to 10%. With a predicted doubling of the unemployment rate in the current recession, there is a high likelihood of increased forced selling, leading to a surge in housing market inventory and substantial price declines. The low inventory of homes in California is due to the aftermath of excessive government stimulus, money printing during the pandemic, and 2 years of foreclosure moratoriums and bans. Moreover, this low inventory environment is expected to last for a while. As unemployment rises, more homeowners will be compelled to sell their homes due to layoffs, mortgage defaults, and liquidity needs. The largest price declines are likely to occur in the most overvalued housing markets, which can be identified using tools like the Reventure app. States such as Tennessee, Florida, Texas, and Idaho have high overvaluation percentages compared to their long-term norms, indicating potential significant declines in home prices. On the other hand, states like Illinois, New Jersey, and Louisiana have relatively lower overvaluation percentages, suggesting they may not experience substantial home price declines. While an alternative scenario could involve income and wage growth improving affordability, there are indications of wage growth deceleration and the Federal Reserve increasing interest rates, which may negatively impact the American worker's wage growth potential. This future supports the likelihood of the home price declines in the face of worsening economic conditions and increased forced sales. And that's it for today, guys. Thank you for joining us today as we explored the shocking move by major Wall Street investors to halt their home buying purchases. This development has sent shockwaves through the U.S. housing market, and we've uncovered some crucial information about its impact on home prices and the future of real estate.